We might get some stragglers as I'm making the introduction because I think we had a pretty full house today. But thank you for joining us and thank you for listening to me ramble about our neighborhood. But you are at the Exit Advisors Small Business Town Hall series. We've got a really important topic today and a very relevant topic that Gary Cooper is going to be presenting on potential tax implications with the election. And we're going to try to keep this as unbiased as possible and just present the potential outcomes from a tax perspective, what it can mean to you personally, what it can mean to your business. And I think that's really kind of chiming into what Exit Advisor is all about. Obviously, as you've heard me rant and go on, we're a lower middle market M&A advisory firm, but we're more than just the transaction. We're not just an investment banking group that gets you through the transaction, which we do, but there's so much more, that the coaching and the education that leads up to it, the preparation work, things like this. How are you going to be impacted by regulatory tax changes, and who do you need to talk to, and how do you need to prepare? And this is just one facet of it. We look at your operations, we look at your employment agreements and your, everything that you're going to be asked during due diligence for the buyer. And we try to do this, many, many months in advance so that we can add value to your business and minimize as much of the risk going into it with a potential new buyer. So again, just reiterating how that differentiates us from your traditional consultants or investment banking groups, because we're very education based, hyper focused with the buyer and very intimate in a boutique setting. And I think the most important, as I've mentioned, we've got guys like Al and Gary who are serial entrepreneurs and who have built businesses and practices from the ground up. They've sold their practices, they've sold their businesses, they practice this from an academic standpoint, from a practical standpoint, helping consult and coach, and they've lived and breathed it as business owners. So, who knows better? They've tackled this from both sides of the table. Anyways, I'm going to pass it over to Gary now, who's going to start diving into what we can expect as soon as maybe next week when we find out what the election is going to bring our way.
Okay, I'll kind of introduce myself. I've got a CPA practice in Houston. As Andrew said, I had one in Dallas. I built it. I sold it. I purchased a practice in Cyprus, built it up, sold it as well, and built this practice up now nicely. And I've been involved in other businesses. I've also was a C-level person in corporate America once upon a time and worked for the Big Four and all those good things. I've got about 8 patents. I've actually manufactured products and distributed to Major League Baseball. And then Al, of course, has built businesses. He did a roll-up in the last century and was able to sell it for a nice price. And both Al and I have been around the block a couple of times and really understand the inner workings of a business. And I think that's what one of our differentiators is for Exit Advisors, is that very thing, is that we're actually, I'm an entrepreneur running a CPA practice, and Al and I are entrepreneurs running an investment banking shop. So that's a little bit different than just a pure financial person or a bean counter or someone who is basically just looking at one side of the fence. So I think both of us have pretty creative minds, both right, left brain, and that's how we can really help our clients and bring them along. So I want to jump into this. I want to cover a couple of things real quick, just kind of leading into this with what we're going into. Well, we're really going into the unknown. Even with the market reacting the way it's reacting right now, I know we have COVID, and COVID's being highly marketed. I think for political reasons as well, but I still think it's very dangerous. I've been very careful. I think I've been in a restaurant one time since March. And so I take it serious, but I think it's also been politicized quite a bit. And that the market's also reacting to possibly what's going to happen in the election, and which we really don't know right now. I think it's really unknown who's going to win this election. So I think what we want to try to accomplish today is just, really stay on both sides of the fence here and talk about what each candidate is proposing. And I'd like people to jump in if there's things that that I don't know at this point, because information's moving rapidly. And I got my information from some very good sources, but things can change. But just some general things before we get into the sterile topic. I mean, things that you should be thinking about right now, when we'll finish out with this as well, but just some things like as we go through these, possibly selling appreciated assets. Because, I mean, if they do change the capital gains treatment for 2021, there could be a lot more taxes that you're dealing with. And appreciable assets can be stocks, bonds, real estate. There's, quite a bit that you could sell. But and on the flip side of that, you've always got to look on return on investment and what your asset base is. Entity selection. Right now, I mean, you look at some people jumped in a C corporation because of 21%. Could go up to 28%. Again, we don't know, but that's just something you may want to look at and consider. That can be done next year anytime, but the entity structures you've selected could be impacted by changes in the tax laws. Just pure tax planning. It makes tax planning a little bit different this year because we may have to look at both years real close. Where sometimes we want to accelerate expenses and defer income. Because of tax rate changes, we may be looking at just the opposite this year. So I think you're really going to have to look at 2020 and 2021 during tax planning. Something else that could be really affected is estate taxes. And so if you want to put together a plan to transfer wealth, we'll cover some more points through this presentation, but there could be some fairly sizable changes there. And we'll get into a little bit more detail. So, again, shifting ground. We don't know exactly what the answer is going to be, but we can certainly cover the things we know today. So my first slide is individual income tax rates. So right now, the marginal rate right now basically is 37%. And that expires, that sunsets on 2025, where a lot of these tax laws do. Trump's plan is to basically try to make that permanent. And of course, that came down a couple of years ago, a couple of percentage points, which everybody, felt like it was really for the wealthy. But I think any kind of rate reduction helps the entire economy. And then he is proposing enacting a 10% middle class tax cut. Now, what that looks like, we don't know, but it's something that he is proposing as part of his platform. Vice President Biden, he wants to increase the top marginal rate back to 39.6% for those who make over 400,000. And I know I've had a lot of responses, been on Facebook putting factual information out, and a lot of people, well, I don't make over $400,000. But I think what everybody's got to consider is a lot of your employers do. And so, especially small business, medium-sized businesses, the people who've been affected the most, even by the 2018 Tax Act, are probably people making between $300,000 and $800,000, kind of squeezed with some of the tax law changes that took place. Okay, long-term capital gains. This could have a real impact. I mean, presently, you got 20%, you got a 3.8% net investment tax. So you could pay up to 23.8%. Trump is proposing cutting the top rate to 15%, and then, an index capital gains for inflation. And Biden is looking at, for people making over $1 million, increasing to the top marginal rate of 39.6%. So this could have a major effect. We can talk about a little bit later. Al's going to talk a little bit about M&A and the effects of possible capital gains and what businesses may want to look at from a standpoint of, gee, it'd be really hard to get across the finish line by December 31st. But it's just something that goes into the planning process. And, there could be ways to transfer wealth and things of that nature. Even if you were able to hustle, if you had infrastructure already set up to do so, it could be something to consider before December 31st. Itemized deductions. There are some changes in 2018 that a lot of people didn't like. One thing was taxes, dealing with property taxes, sales tax, and state income taxes being capped at $10,000. That was something that, of course, a lot of my clients didn't care for. And certainly people who live in states like California, New Jersey, and New York really got hammered not being able to deduct the state income tax or having a ceiling of $10,000 on that. And, Trump wants to make his particular law permanent. There were things in that I didn't love. There's things in that law that my clients didn't love. Employee business expenses were eliminated. And so, itemized deductions is kind of a tricky point that affects a lot of people. And then Joe Biden, he wants to restore the please limitation, the 80% cap on the itemized deductions for those who make over $400,000 a year. And so I don't know if people remember the limitations that were in place to where you only got the 80% and you had the limitations on the itemized deductions. Obviously, the people over $400,000 are the ones affected because they're the ones that have to start cutting itemized deductions out of their tax return. Self-employment tax. Okay, as we know, Social Security 6.2%, wages up to 137.7. That is stair-stepped up over the last several years. Your Medicare tax 1.45%. And then you got extra Medicare taxes too for those who make more money. And so, Trump doesn't want any proposals made on this. The Biden camp, they would impose a 12.4% tax as far as people who make over $400,000. And this could be split between employer-employee. For employee base, if you are a contractor, and you could probably expect self-employment taxes to go up. So once again, it's another tax increase that could be imposed. And I want to clarify another thing too. I mean, I know that Trump is making no proposed changes, but what we've all got to keep in mind is that this country's just gone into a lot of debt because of COVID. And we don't know how long it's going to take for us basically to get out of a tailspin as a result of it, with it peaking again. And so I just think, this is me personally, this is my opinion, taxes are going to have to go up no matter who takes office in certain areas. Now, I can't speculate on what those certain areas could be, but, the country cannot continue to go into a deeper deficit. So just keep that in mind as we go through this. And I want to be as unbiased as I can as far as throwing out what I have and what I've been able to gather. And keep in mind as well that, as far as the Republicans and the Democrats, the Republicans have always been pro-economy, reduction of taxes, and Democrats have always been, for increasing taxes and larger government. So that's just generalization, but that's been fairly typical during my lifetime. Qualified business income. What a mess this is. This is one of the most complicated computations that's ever been put into the tax law. Everybody thought they were just flat out going to get a 20% deduction. Well, quite candidly, right now with the current law, there's a lot of phase outs. There's phase outs at the entity level. There's phase out at the individual level. There are certain businesses that do not qualify for the 20% deduction, including accounting practices. So, this is kind of a difficult thing to compute and get your head around, even for a CPA. As far as Donald Trump is concerned, he wants to make it permanent. I certainly wish he would simplify it if he makes it permanent. And then Joe Biden phased out for qualified business income. It's called Section 199A for filers with taxable income above 400,000. So once again, small business people, a lot of people who have your, $5 to $10 million companies are probably making, $600,000-700,000 a year, but they're creating jobs, and this is a deduction they rely on. And basically, those creating jobs are going to pay a little bit higher taxes as a result of that change. Like-kind exchanges. And this would really affect those who do real estate. And let's face it, real estate has become a very much an alternative investment opportunity for a lot of people. A lot of people are skittish on the stock market just because of the volatility. With things that are going on in this country, this world, I think we're always going to experience that. I think the volatility is going to be there. And a lot of people feel like real estate, could be a little bit safer bet. It's a little bit more permanent. You show a return on investment on a more graduated basis. And like-kind exchange is something that, of course, real estate professionals have worked with for years, to where you set up an intermediary. Basically, you're able to take a piece of property and sell it and roll the gain into a new piece of property, so therefore defer the gain. So you don't have to pay capital gains until the final sale. And then, of course, that gets into estate taxes, where step up in basis, where it gets left to a beneficiary, where you may not have to take the gain at all, or they would basically assume the basis. But Joe Biden, in this case, people who make over 400,000, he wants to eliminate like kinds of exchanges. And keep in mind too, the 2018 Tax Act eliminated most like kind of exchanges except for real estate. So this would kind of dig in deeper on this particular area. Let's see. This one. All right. How this thing's, all right. I'm sorry, this thing kind of flip-flopped on me. Corporate tax rates. All right, so this tax law was put in place in 2018. At one time, they were graduating corporate tax rates up to 35%. This was a big deal. And, it's really interesting. The tax law change, here's the thing about most tax law changes, period. They're supposed to be tax null. And this is something I guess I can claw in, to the Trump regime a little bit, that obviously corporate tax rates went down a lot. And so that had to be made up in other places. So me personally, I feel that individual taxes across the board went up. They did go down for lower income. They did go down for higher income. But I think the people who are squeezed in the middle, some may be paying a little bit higher taxes as a result of those tax law changes. As far as the corporate rate, though, Donald Trump has no proposed change for that. Biden's already come out and said he wants to change the marginal rate to 28%. And then this is kind of interesting. For corporations reporting more than 100 million of annual book income, enacts 15% minimum tax on book profits. So in the 2018 Tax Act, alternative minimum taxes went away for corporations. So this could be another way to basically put alt minimum taxes back in. I'm not sure if that will happen for smaller businesses, but I can see that there may be increases at the corporate levels. Gift tax. All right, this is one that could really have a major impact on the baby boomers, of course. But this would really enhance the need to do tax planning. And so right now it's 11.58 million per donor as far as the lifetime exemption. So what the lifetime exemption is you have each individual. So a married couple, it's like 23 million. that basically can be left to your beneficiaries tax-free. And you can also start gifting now and basically file gift tax returns with lack of control and lack of marketability discounts to transfer wealth. And, the $23 million is for most is a pretty, high level. And so it makes it a little bit easier. It did away with, a lot of people having to buy life insurance, to protect assets that were going to be gifted or basically left, in a will. And so what is being proposed by the Biden regime is to go back to the 2009 level of 3.5 million. And also, this is really big, eliminate the step up in basis on the assets inherited at death. And so what that would mean, let's say that someone passes away in your family and they have a house and its market value is $1 million. All right. But that house was bought many, many years ago for $10,000. I know that's a really crazy example, but if they do away with the step up in basis, that means you inherit at a $10,000 level, not $1 million level. So basically you go and sell it, you're going to pay capital gains on the sale of that house. And if they do away with capital gains rates, then you could actually pay, basically 39.6% taxes on the sale of that asset. And so, also something else to bring out here, there's these discounts called lack of control and lack of marketability. Now, they wanted to try to eliminate that. I want to say it was 3 or 4 years ago, and it didn't get through Congress. But what that means is, and I know, this is something that people have been able to take advantage of for years. When I'm going to tell you, you're probably going to say, wow, that isn't right. But, if you are contributing an asset, say to a family limited partnership, and let's just say something simple like $100 CD, and you're transferring it minority interest to one of your beneficiaries, then you get a lack of control and lack of marketability discount, because basically the donor is the general partner. So as far as your gift tax return is concerned with those discounts, you would only have to probably file an amount of $50 against your lifetime exemption instead of $100. So basically, instead of the 23 million, it's more like 46 million that you can transfer down line with those discounts. And there's speculation that could be something, if the Democrats were to control the House, the Senate, and the presidency, is something that they would look at really hard. And it's something the IRS has certainly wanted to get rid of for years. Well, we just talked about this, the step up in the basis. So, this again is something really important. I mean, even small clients that I have that receive an inheritance, $100,000, $200,000, and they get the family house, they get certain other assets, and being able to step that up to market value and sell it, not have to pay taxes on it, as a real benefit, I think, to everybody in this country. Qualified Opportunity Fund. Well, the Opportunity Zone was put in 2018, and there has been, really, really good activity on that. We've had clients who's invested in opportunity zones. They've been able to defer their capital gains. They can defer capital gains all the way up to 2024. And then at that point in time, they only pay 85% of the capital gain. Then if they hold the property or the business up to 2030 and they sell it, then there's no tax. So, this is something that's really was put in place to help areas that need help, right? Low income areas. And there's no proposed change. Well, I think Biden is looking at this from a very positive framework, though. He's looking at focus on creating jobs and developing low-income communities and partnering with non-for-profits, community organizations, transparency on investment. So I think this is a positive thing for him, that he wants to take this and take it a step further and really try to enhance lower income areas and try to build infrastructure there. Accelerated depreciation. This is a big one for small businesses. It can certainly have bad future impacts because you're basically deducting property the year you purchase it. So, but you got to consider all the industries that would affect if they were to do away with bonus depreciation and really slim down Section 179. Because you've got, you know, automobiles, you've got equipment, you've got, I think, leasehold improvements are included in bonus depreciation. So it's really enhanced a lot of these companies, you know, that construct this type of asset for the customers to come out and purchase it, knowing they can get a deduction immediately on their tax return. Uh, and then, you know, Trump wants to extend this to 2025 and continue with that process. Biden has no specific plan, but generally supports reversing the 2017 provision. So we don't really have factual information on this, I guess, but the rumbling out in the marketplace is that this is something that they would want to do away with in the future. Penalty for business operations moved overseas. There's currently no law. There's no proposal at this point. This is something, a 10% penalty surtax on profit from any production by U.S. businesses overseas for sale in the U.S. You can look at this from a positive standpoint. You can look at this from a negative standpoint. I mean, you know, we do have to become more dependent on ourselves as a country. We need to bring our manufacturing back. We need to bring jobs back to the United States. From a standpoint of timing, how you do that, how you stage it is going to be very important. You know, what you've always got to consider when you look at a tax like this, it's going to come back to the consumer. Even, you know, when Trump was imposing the sanctions on China, you know, a lot of the businessmen in China was, well, we'll just increase our prices. And in doing so, the consumer in the United States pays more for the product. So, you know, you've got to always look at the economics of any type of tax change that affects the cost and the production of any kind of product. Credit jobs in the U.S., currently no law. Trump proposed Made America tax credit, but no specific plan announced. Okay. Biden, 10% Made in America tax credit for companies that create jobs for American workers or that increase manufacturing wages above the pre-COVID-19 baseline. So, you know, once again, this is a positive thing from a standpoint of looking at it, American made, creating American jobs. So, you know, a plus for Biden on this one. Manufacturing credit, right now, nothing. Trump, no proposal. Biden does want to enact a manufacturing credit, manufacturing communities credit. And so, again, you know, when I talked about tax null, all right, so you look at these things and you look at these credits, you know, for manufacturing, for production, for employees and businesses. Well, if there's reductions in taxes in one vessel, there's got to be increases somewhere else. And so always consider that almost every tax act is tax null. Community development, present law, new markets tax credit is available for taxpayers who hold qualified equity investments in low-income communities. Trump has no proposal to change that. And Biden, once again, he wants to expand and make the NMTC program permanent. And so, you know, if you look at the flavor of this, and I think the flavor of what the media focuses on is who Biden is trying to basically benefit and who Trump's trying to benefit. But I think you need to look at it rationally yourself. And as the things we talk about today, just, you know, determine, all right, who really benefits from these changes, who benefits from these proposals and platforms, and then how's it going to affect me as an individual? And you got to also consider how it's going to affect companies who's producing jobs. The fossil fuel is something really interesting. I mean, obviously in debate, There's been talking points by the Republicans now since the debate about, fossil fuels. So, there's several deductions currently that exist. No proposal to change the related fossil fuel. Repeal the electric vehicle credit. As far as Trump's platform is concerned, Biden, end fossil fuel subsidies, reinstate or expand various tax credits designed to reduce carbon emissions. And so obviously the Democratic platform is for clean air emissions. And, Trump's platform is basically for us to be able to create our own energy. So, you got to look at that and how it basically affects the way the tax laws are written as well and what's being proposed. So I'm going to see if there's any other ones that I'd like to bring out right now that, a couple of things just that could come about. And I'm not sure what the rumblings are on this, but, they've talked about a wealth tax. And so this wealth tax, I've heard some people say it's going to be on our property to where we would basically pay a federal property tax. I've heard some say that it's on pure wealth of wealth that's been amassed over a lifetime and basically charge a tax on that. And so there are, some things out right now being discussed that are not basically factual at this time. And I think you're going to hear a lot that's not factual at this point in time that you're going to be basically guessing. So for that, I have this crystal ball. I'll set it here as we talk about the rest of the things. All right. So, what's in sight for our economy? Let's kind of talk about that. And then I'm going to turn this over to some of my business partners to discuss as well. But as I mentioned earlier, certain taxes, I think, will have to increase to cover the deficit from COVID-19. The country has gone into more debt. I think it's going to probably have to have another stimulus package passed for certain businesses, especially restaurants, bars, the airlines. There's people who are still deeply affected by COVID-19, and it's not their fault, obviously. Has this been well managed? I think I'm not sure you can even, determine that, because nothing like this has ever happened before, especially on a worldwide scale. But I do think they're going to have to do things to generate tax dollars. Obviously, if you look at what we just discussed, the Trump platform promotes the expansion of the economy to generate more tax dollars and versus imposing higher taxes. I think largely the Biden platform is going to create tax increases across the board. I think it's been said in certain debates, and I just feel that that's what's going to happen. And if you look at the differences in the two platforms, I think you can see that there are areas that's going to create increased taxes. Now, is Trump's expansion of the economy going to be successful? And how quickly is the economy going to expand is what you got to really put your finger on. And you know something? Running a country is like running your household, all right? You got to go buy food. You got to pay your car payment. You got to pay your house payment. Well, this country is in the same position where it's got payments to make as well. It's got different things to fund. So, it's got to have enough revenue to cover its expenses. And here lately, it hasn't. So again, I think you may want to look at potentially higher taxes just in different areas. The M&A market, certainly if capital gains, taxes are increased, it's going to have a huge effect. There's going to be people postponing selling their businesses because of the tax they may have to pay. Look at it this way. Let's say that your number's $5 million and you can retire on $5 million, right? And if the tax is doubled on that, instead of selling that business, for $6 million, now you're going to have to sell it for 7 or 8. Well, you may not be able to get to that number. because, let's face it, willing buyer, willing seller. So it may postpone people selling their companies and really damage the M&A market. And then, I look at this from a different standpoint, what it could damage as well, because, when somebody buys a company, right, they're going to go out and they're going to try to grow that company. And when somebody sells a company, they've amassed wealth. So they can take that money and put it in the marketplace and make it work for them, but also, rev up the economy as well, because more money is going into the economy. Really, on both sides, more money is going into the economy. And so you got to look at the importance of the M&A market, estate planning, right? We talked a little bit about this on the lifetime exemption. If it goes to 3.5 million, that's going to really affect the way that people start looking at transferring wealth. And I think it's going to help estate attorneys quite a bit, and estate planners, because now, people are going to have to start buying ILETs again, insurance policies, putting them in an irrevocable trust, to cover basically future estate taxes. And, I think gifting, even this year, with the lifetime exemption at what it is at 11.4, you may want to consider that. You may want to consider the family limited partnership, pressing, go ahead and basically transfer some wealth to your beneficiaries while you have a higher lifetime exemption to file a gift tax against in 2021. So increases, like I said earlier, you look at the $400,000 range, and a lot of people say, well, that doesn't affect me, but it affects business owners. And business owners are who create jobs, and they create raise increases. They basically prop up the economy. They allow the consumer to have more money to buy the products you sell and distribute. And so you may say, well, there's not that big of a deal, a change with the $400,000, but there really is. It really affects the entire economy. And as we mentioned many times, the economy could take longer to recover. We're not sure yet. We're not sure, when it's going to really open up. I heard rumors today that certain cities are putting lockdown orders again. And so we don't know, what the recovery period is going to be, how many more stimulus packages are necessary, and what it's going to take, to cover the costs of the pandemic. And then another thing I look at, is the IRS. This would be a double whammy for all of us. If the government sees that they need more money, I could see them ramping up the IRS again and increasing audit activity. So I think it's something that the government would consider, and the increase of taxes. And I think even both sides of the fence could consider that. So hopefully this has helped. I'd like just to go into a discussion. I'd really like my business partner, Al Danto, to speak up a little bit on his thoughts and concern with the M&A market, and what, taxes, how they will affect it, and what the two platforms will do to either positive or negative effects. Al, if you can jump in.
Hey, Andrew, if you could turn my video on, I'll come online. Gary, I'm not going to, great job navigating and walking that tightrope. I'm not even going to try to even kind of go down the same road that you did. But I think the really important takeaway from what Gary said is all of these are going to impact different people in different ways. So you could be on the good side, you could be on the bad side. It's really, really important to take a look at all the ramifications, how it's going to affect you if you own a business. If you have 401k, everyone pretty much has 401k investments, and really take a look. If the Democrats do come in and they take over, then they're going to spend more on infrastructure spending, right? They're going to in general, collect more in taxes and spend more on infrastructure and provide more benefits from a government standpoint. So who's going to benefit from that? Who could potentially benefit from that? You can look at construction companies, building companies, a lot of government contracts. So who's going to get these government contracts? some veteran-owned companies, minority-owned companies, women-owned companies, they stand to benefit from a lot of this. So the main takeaway here is we're going to have it. If we do have a change, there's going to be some pretty significant changes the other way. If Trump stays in office, maybe it's tweaked a little bit. Like Gary said, probably some type of increase in taxes, but maybe not as impactful. But if it swings back the other way, there will be. And I want to give an example of what happened in 2016 when the corporate tax rate went down from 35% to 21%. Taxes to a business and to a corporation are an expense, just like any other expense. So in essence, in 2016, businesses, corporations, C corporations got a 14% savings in expenses. And you could combine that with accelerated depreciation. Knowing everything that I know and teaching this at Rice and being a certified valuation analyst, should have went out there and bought you just started buying stocks, right? I don't think we've ever had that big of an increase to savings in corporations at any given time, right? Hit the bottom line, all that money was reinvested and we had some good growth and it continued. So we can see an impact kind of go there. So really my main input on all this is see how it impacts you. See how it impacts you. And understand that to a business, businesses are not valued on EBITDA. EBITDA, earnings before interest, taxes, depreciation, is really just a metrics. Businesses are valued on free cash flow. How much cash flow is left after they pay all their expenses? So you have to take a look at that. Like Gary said, capital gains are huge. Are huge, and if they go from 20% now, and if you sell a business or sell a company, and they go to ordinary income at the highest rates, they could in essence almost double. That's a big chunk. You have to also consider that for some built-in gains on stocks that you have, even stuff that's in your 401k if you hit retirement age and start to take it out. So take a hard look at how this can potentially impact you all the way around. There's another thing called a 1202C election, and a lot of small business owners don't know this. For the last 4 years, we've kind of been advising that it looks like the best corporate structure for a startup company is a C corp, 21% tax rate, and in essence, if you hold on to your originally issued stock, I believe it's a 5-year holding period. Is that what it is, Gary?
Yes, 5 years.
There's zero capital gains if you sell it. So some business owners are really shocked to hear you say, if I would have set up as a C corp, built my company and sold it, I wouldn't have any capital gains tax to sell, to pay. So these are serious considerations. And again, my insight to this is really just kind of take a look at the companies that are going to benefit, how it's going to impact you. Talk to your CPA, talk to your financial advisor. Our town hall in December is going to be with a financial advisor. We'll know who's in office by then, and it will be on some year-end tax and financial planning strategies that you can do. So, Gary, that's, let me see if I made any other notes. Regulations are huge to the industries. And I think, again, one party has said, maybe eliminating a lot of fossil fuels, eliminating fracking. The others not. How's that going to impact Houston? How's that going to impact your company, your investments? So take a serious look at it, be cognizant of it, talk to your advisors, and we'll see what happens next week. And a great job on this, Gary, really navigating it.
I'm going to call on somebody else by a surprise here, but I'd like to call on Jason Knight just a little bit because he's an EOS implementer. And so he really gets into the operations of a business. He's the EOS implementer for Exit Advisors and Cooper CPA Group. But, Jason, I like your perspective because, you're sitting there with management, you're helping them with core values, you're helping them navigate. How do you see these different tax platforms affecting your clients?
Well, I think a lot of what you've already touched on. The reality is what I'm finding is that most businesses are not spending enough time being strategic when it comes to taxes. It's funny, we're quick to, from an operational standpoint, go to areas where we can save money on the bottom line, or we can increase sales on the top line. And this is something we've talked about in previous sessions, but there's money to be had or found by being smart in your taxes and the way you handle your accounting. So that's money, it's already there, and might as well take advantage of it. So to answer your question, I'm definitely finding that not enough leadership teams spend time thinking strategically around their taxes, their corporate structure, and how to best take advantage of that. And so I absolutely think getting with someone like Gary or an expert to help you navigate that it's just putting money in your pocket. It's money that doesn't have to be spent, and it goes along with building a good, strong sales strategy and a cash flow strategy. This is an automatic piece that should be included in that.
Yeah, I want to reiterate, Al said this and Jason said this, is get with your professionals, get with your CPA, get with your financial advisor, get with your attorney, and get with your EOS implementer. I mean, this is time for you to get people around you, get their takes, get their guidance. Especially, I can tell you the importance of tax planning before the end of the year in an effort to minimize your taxes. I can tell you from an M&A standpoint, it's time to start looking at putting a succession plan together. Exit Advisors does an excellent job on that, helping you navigate, figuring out what your numbers should be, and putting a plan in place, getting the data room set up, getting everything ready in case you get the knock on the door. And, financial advisor, how should you be invested? You got different other types of investments. Maybe you get a real estate guy, but, really take a step back and look at what COVID has done, look at where things could be headed, and put together a solid plan. I think it's time to do that. And, plan on executing on that plan before the end of the year.
One thing I encourage teams to consider is really looking at the business and running it as if it were always for sale, right? So you're always in a position where you've got your house in order, where you're operating things efficiently and effectively. So if someone ever did, like you said, the knock on the door, not only are you organized and ready to deliver the data, but you're operating in a mode where you're at maximum value all the time. And I think there's a lot of benefit to that. Obviously, even if you're not for sale, operating in that from that stance is going to make you more profitable anyway. But I agree. And again, I think getting with Gary and folks at Exit Advisors will help you understand what that really means. We can talk operationally what that means, but what does it mean from a structure standpoint, tax standpoint, and reporting, due diligence, all those things? What do you need to have in order?
Andrew, do we have any questions? Oh, your microphone's not on.
Yes, we lost Andrew.
Last time mute. Does that work? Andrew?
Sorry about that.
All right, there.
There he goes.
God, you'd think after a million Zooms, you would have this figured out. No, sorry, we do not have any questions as of yet, but if anyone wants to raise their hand, or you can use the Q&A chat, I can unmute your mics right now if you want to chime in on the conversation.
Hey, Gary, I have a question for you.
Okay.
Okay. Given all this, how are tax changes implemented and how long does it take? Can the president just say he wants to make these changes and they get made, or what's the process for it? And when do you think they would go into effect?
Well, it's got to go through Congress, got to go through the Senate. It's got to be signed off by the president. And of course, if the Congress, the Senate, and the presidency is held basically by the same party, I think it could get pushed through in 2021. They could work pretty quickly to do something, basically the COVID overhaul act or whatever they want to call it. But they can move quickly on that. Trump moved quickly on his tax act. If you remember, as soon as he started working on it, it got passed through fast. So yeah, I think you could see some changes in 2021. That may be effective even January 1st.
And as long as it's completed by the end of the year, then it's effective for the whole year.
Well, I think they have the power to do that. I don't want to quote and say for sure, but I believe they have the power to go through and say, typically though, Al, I mean, they would say for tax years beginning January 1st, 2022. So 2021 could be a year that is kind of a lame duck year to where you still got the same tax laws. And, certainly if I was considering selling my business, I would start thinking about a succession plan right now, with hopes that the capital gains would stay in place for 2021 if you got the deal across the finish line before then.
I'd say, yeah, just to play devil's advocate, that's probably the fastest it could go through, and it could certainly be in the direction of moving fast with, with using stimulus and COVID as kind of the underlying motivator. Personally, we've talked to some buyers for current deals that we're working on, and they want to get things done quickly for this exact reason. But, we're also saying that this could, 6 months from now, they'll pass legislature, and the legislature will go into effect 6 months after that. So it could even be June of 2022. But, that's a very conservative and optimistic, standpoint. It could be as soon as the end of this year if they use COVID and stimulus and economic impacts as kind of the motivator, and it could get pushed through quickly. So, but to your point, I guess to summarize what I'm trying to say, it is important to start thinking about it now and to start preparing now.
I think so. I think you take a look at, even if you get your CPA to put together some calculations of value, look at what your company's worth, really do a basis analysis where you understand what your tax basis is. If you were to sell your company, what your capital gains would be, what an asset allocation would look like if you sell your business, where if you've taken accelerated depreciation, you may have some ordinary tax rates embedded in that. So I think it's important for you to start planning. If you have in mind to sell your company in the next 3 years, I really think you ought to start looking at it right now with your advisors. And, numbers don't lie, man. You get somebody to put these analysis together for you. They're going to paint a picture that may have you decide to do something sooner than later. So I think that should really be considered. And I think this year, tax planning, I'll toot that horn again. Go to your CPA. I mean, it's, you had COVID, there's a lot of opportunities. Al and I were talking earlier about, converting Roths. If you've had a really bad year, down year, go ahead and pay the tax at today's tax rates. And maybe you're in a lower bracket if you didn't have such a sterling year with COVID here. So, I think it's really important. It's dollars in your pocket. That's what it comes down to. So year-end planning overall, you got to get it done. This is the year to do it.
Yeah, I guess, Gary, that's always the worst thing for us to hear is I said, man, I wish I would have known that or did this or did that. And then, after January 1st, it's too late.
Yeah, well, that's what it always typically is. It's too late, especially after December 31st. I mean, it's, it's just history. And we'd love to talk to you at Exit Advisors. If it's something you want to consider, we've got a really good network that we can even help smaller businesses with our network of business consultants. And so it's not going to hurt you to have a meeting. So give us a call if you would like to discuss a succession plan and an exit strategy.
And I'd just like to add too, it's really important to look at all your investments, see which your 401ks are in, see the impact of that, see any stocks that you own, and you know, how they're going to be impacted by this and some of these changes.
Yep. All right. Well, I appreciate everybody listening today. November the 4th, the most common risk to mitigate or eliminate when buying or selling a company. Company-specific risk is really important to understand. And as you're putting your succession plan together, it's something you definitely want to eliminate to get that higher multiple. And I know Al knows a lot about it. And we're going to have a featured entrepreneur on the 18th, the 11th. Hopefully, got someone planned that can come in and talk about hidden risk through due diligence, basically sell side. So got some good topics coming up. Hopefully you guys will join us.
Thank you, Gary. Great job.
Thanks,
Appreciate
Gary.
it. Thanks, guys. Talk to you soon.